Hey everybody, welcome to this month's Nashville Investor Workshop webinar. I'm your host, Rob Folia with Folia Properties at Keller Williams Realty, and we can definitely go ahead and get started. Before we jump into everything in this month's topic, I do want to just give you all, especially if this is your first time checking out our webinar or our workshops, just kind of a brief intro into what we do at Folia Properties as well as just our workshop's overall mission. At Folia Properties, our goal is to help others build their legacies through real estate. We've just seen how powerful real estate can be to help somebody grow their wealth and their legacy, and that's our goal is to help others with that. And basically, our workshop's mission is to help others learn how to invest in real estate so that they can build wealth and leave a legacy. When it all boils down to it, I've seen all too many different types of junk out there when it comes to learning how to invest in real estate, whether it be classes that you got to pay through the nose for, or just things that don't work, or quote unquote networking groups that you pay for that you don't get much value from. And our goal here with these workshops is simply to give everybody a free place to learn some great information and place where we can all mastermind and network together. So I definitely appreciate you checking this out. And if you have any questions, definitely either type it into the chat box here, or you can email us if you're watching this on recording at info@foliaproperties.com, info@foglia properties.com, and we'll get back with you and answer any questions that you may have. So let's go ahead and jump into our topic for this evening. Ultimately, as you can see on the screen here, I want to invest. Where do I start? It's somewhat of an introductory topic into the numbers, really looking hard at the numbers and identifying what makes sense for an investor to consider when it comes to a property. So we're going to look at actually two types of calculations this evening. One being what you see here on the screen here for cap rate. The second one being what I call the 1% rule. And we'll get into the 1% rule here in just a couple of minutes. The first one, though, as you can see, is the cap rate. I personally believe a cap rate is great for comparing properties and calculating your return on investment for specifically multifamily units or other investments. I think you can use it for single-family properties as well. I would say, though, that it's typically the best system to use when you have a lot of expenses to calculate. As you can see on the bottom of the screen here, when you have things like association dues to take into consideration, property management, maintenance on a property, insurance, lawn care, things that taxes, things that you don't want to forget about when you're calculating whether or not a property is going to be profitable. You want to make sure you have those included. So that's basically in a nutshell why you'd want to use a cap rate. And what is a cap rate? It's basically a formula that helps determine how profitable an investment may be. And you can see the formula on the screen here. The cap rate is going to equal what your annual income from that property is going to be minus your annual expenses. So basically just your gross profit for that property over the sales price. And we, as you can see on the screen right here, to me, ideal in our market here in the Nashville area for right now is to aim for at least a 10% cap rate or higher. I'll be honest, it's getting harder and harder to find those 10% caps and or better. So I would say if it's a great property, you get it at a great price, 7 to 8% for cap rate, it can be worth considering. It's got to be a property though that makes sense. You may see on the rise, or a property that is possibly you're getting a great deal on, that you're going to have a built-in equitable stake right away in the property. So that's when it may be okay to consider less than that 10% rate. Honestly, one of the main reasons why I say 10% is kind of a magic number, and we'll get into another formula here in a second, that 1% rule, and that's that 10% for a cap rate tends to still be pretty profitable when we're talking about having a mortgage on a property that you're paying back. And it's just kind of a benchmark to make sure a property actually makes sense as an investment. Again, it's worth considering it still if it is around that 7 to 8%. However, it's got to be the right property. Let's go ahead and walk through an example right here. I'll click on the example in just a second. However, this is a real-world example that we purchased last year. And as you can see, the sales price is $118. Our annual income worked out to be $15,600, and our annual expenses $2,700. You can see the formula that we're working with right here. It ends up to be almost an 11% cap rate. And to kind of show you what it is that we're working with, basically what this is a multifamily property up in the Clarksville area, just a little outside of Nashville here. And it was a property that ended up selling for $118. And as you can see in the details here, it's renting out for $650 a side. It's a duplex. So pulling in $1,300 a month. And so to jump back to our slide here, you can kind of see kind of where those numbers are coming from. And there are real world examples that are out there that actually make sense as investment properties. I think all too often we get caught up in thinking about how the market of the moment is a seller's market here in Middle Tennessee, and it's hard to find those great investments, when in reality, you've got to know where to look, and you got to be looking for the right properties and be willing to jump on them right away. This property that I just showed you a moment ago, that was on the market for about 2 days before it went under contract. So it's a property that you've got to be willing to grab, basically. Let's see. Let's go ahead and jump to the 1% rule. And in my opinion, the 1% rule is something that is ideal for single-family homes, ideal for calculations that are a little simpler than when you have to worry about lawn care and property maintenance and things that are consistent expenses. And we'll get into, well, actually you can see on the screen right here that the 1% rule is simply taking your monthly income, so not your monthly profit, just what your monthly rental income will be on a home, and dividing that into the sales price. You want it to be greater than 1%. So just to talk easy round numbers, say you identify a property that you believe will rent out for $1,200 a month. You'd want to make sure that the sales price to hit this 1% rule is right at that $120,000 mark, or obviously lower, it would be even better as an investment. If it's much higher than 120, it's going to be less than 1%. You've got to then identify, just like we talked about with the cap rate, you've got to identify, hey, is it a property that you've got you're getting at a great deal, so you're going to have a large amount of equity going into it. Is it a property that just makes sense? It's in an area that, is on the rise and is going to be, obviously no one has a crystal ball. However, I would say in a neighborhood that you believe is going to be, be worth a lot more than it is today. When you have some of those things to consider, you may be able to bend a little bit from that 1% rule. However, again, I wouldn't advise it all that much. And the reason for it is, you can actually see at the bottom of the screen here, when we're talking about profit, we're talking about that your profit, really is your income minus your expenses and your reserves. And in my opinion, those reserves really should be your monthly rental income times 0.1%, so 10%, times 0.1 or 10%. And the reason why, and I'll switch to the next slide here, is because you can see on the bottom that I'd personally advocate that you should save at least 10% of that, the gross income. So now, again, not your net profit, just what your gross income is from a property. You should set that aside just for vacancy and repair, because there will be times on those rental properties where you've got to replace an HVAC unit, you've got to replace a roof. When things just go wrong, when you have a tenant that moves out, those things happen and you have a vacancy, and you've got to have some money set aside, because if you're running this like a business, as you should be, then having those reserves allows you to dip into the business funds rather than into your personal funds. So again, what to aim for? With the 1% rule, you want to be aiming for that monthly income, so your monthly rental income before expenses, before anything else, to be more than 1% of your sales price. And that's just how you really can make sure that it's a profitable property and something that is safer. If it's a situation where you don't have as much of a buffer built in, you're running the risk of running into trouble down the road. Just to see how things look, just going back to that last example with the cap rate, because again, this whole purpose of tonight's webinar and workshop is to give you a couple of different ways to identify an investment and whether or not it makes sense financially to move forward with. You can see how the 1% rule applies to that duplex we had pulled up a moment ago, and I won't pull up the property again necessarily. However, you can see right here that with a sales price of $118, monthly income of $1,300, that's easily hitting the the 1% rule. I mean, it's as you can see right here, 1.1%, which is great. Monthly reserves, you know, putting 10% aside, at 130, there's easily enough of a buffer right there, even after a mortgage on 118. And monthly expenses on this property are still also relatively low because it's, you know, a smaller property that we're basically only talking about interest. We're basically talking about, not interest, excuse me, insurance and taxes. So, yeah, it's pretty straightforward then when it comes to the profit right here. Let me see. Let's go to the next slide. I know we're hitting our Q&A section early here tonight, and I'm going to get away from the full screen so I can check out. It looks like we've got one question here. Do we recommend separating your business account from your personal account? How do you handle reserve, income, and expenses? Great question. So I definitely do recommend separating the business account from your personal account. And just for that reason I mentioned before, you don't want to put yourself in a position where you're you basically don't want to put yourself in a position where you are having to dip into your personal funds to pay for your business expenses. That kind of goes down a slippery slope, and it makes takes the fun out of owning a business, an investment business that's on the side and producing some passive income. In terms of how do you handle reserves, income, and expenses, it's for personally how I handle them for my rental properties. It's pretty straightforward. Because I'm looking to grow my investment portfolio pretty large, I don't touch the profits, and I keep them all as reserves because I'm honestly a little conservative when it comes down to wanting to make sure I've got money to replace a roof that may be getting old or replace a HVAC unit that, you know, may be getting toward the end of its natural life. And so, you know, I'll treat almost all of my profit as reserves. Now, granted, again, that's very conservative, a conservative way to look at it. How you can look at it is just say you're an investor that you want to own maybe one or two rental properties, and you're thinking that, you know, that you'll be happy in that instance. Kind of look at the property and see what may be on the horizon in terms of repairs. Is that HVAC unit 12 years old? If so, I mean, yes, it could last another 10 years. The odds are against that, though, and the odds are that you'll probably have to replace it in the next 2 to 3 years. So you may want to build up that reserve account to where you do have that couple $1,000s to replace it. Same goes for the roof. If that roof is, you know, 20 plus years old and it looks like it's seen better days, you want to make sure you have the reserves in there to replace that roof to where it's not a tremendous expense that you have to dip into your personal funds to take care of. So, you know, that's really the biggest thing when it comes to the reserves. And then with the income and the expenses part of that question, that's all about separating the business and the personal. Another reason why you want to have them separate. And so, you know, for instance, when every time you take a rent check, or, you know, I collect a lot of my rents electronically. And so when I do collect those, they all go into a separate account. So the only income, the only deposits that I see into that account, all rental income. Then expenses, the exact same thing. Since everything is separated, whenever I do have an expense, when we have a contractor who has to go out and fix something, or we have an appliance we need to replace, it all comes out of that one account. It's easier to keep track of. It's easier for tax purposes. It keeps things organized in a way that allows us to be successful with it. Hope that definitely answers your question. You know, if we had any other questions here tonight about just about any of the numbers that we looked at here, or any of the about everything, I've got a thumbs up for that. So awesome, y'all. I'm glad that helped. If we don't have any other questions, we can definitely end this one a little bit early tonight. Definitely hope to see you at the next webinar. Again, our whole purpose of these workshops and these webinars is simply to provide y'all this free place, this great place, almost a quote-unquote safe place for y'all to come learn about investing. And, you know, we're never going to sit here and say, hey, there's a sales pitch at the end of this. We're not pitching a property or pitching a system or anything like that. All we do ask is that if you're getting a lot out of the message that we're sending across, that when you do have some real estate needs, give us a shot. We're here to help. And if you do need anything, reach out to us, I should say, at info@foliaproperties.com. Again, info@foglia properties.com. Let's touch base, and we'd love to help you any way you can. Definitely appreciate it, y'all, and look forward to talking with y'all soon.